Imagine you could control the price of everything in your country with just a few decisions. You could make houses cheaper, jobs more available, or prevent the entire economy from collapsing. This isn't science fiction, it's already our reality. There are institutions that actually do this every day, and most people have no idea how they work behind the scenes. These are central banks, and they might be the most powerful organizations you've never really thought about before today. Let's start with the simplest possible version. A central bank is essentially the bank for all other banks. Just like you have a bank account, every commercial bank has an account at the central bank too, in exactly the same way. But here's where it gets really interesting for everyone involved. Central banks have a superpower that no other institution has. They can create money out of thin air. Now let's add the first layer of complexity. Central banks don't just store money for other banks. They set the fundamental rules of how money works in an entire economy, shaping decisions at every level. The most important tool they have is something called the interest rate, quietly influencing everything else. Think of this as the price of borrowing money throughout the entire country, affecting everyone equally in ways most people never notice. Here's how this works, in practice, across the entire economy. When the central bank raises interest rates, it becomes more expensive for banks to borrow money. Banks then charge higher rates to their customers. Suddenly, getting a mortgage becomes more expensive. Businesses think twice before expanding, and people save more instead of spending. The economy cools down, slowing growth, spending, and overall momentum. When the central bank lowers interest rates, the opposite happens. Money becomes cheaper to borrow for households, businesses, and institutions everywhere. Banks offer lower rates to customers across mortgages, loans, and credit products. People buy more houses, businesses expand, and spending increases across housing markets, goods, and services. The economy heats up with faster growth, risk-taking, and expansion. But this is just the beginning of a deeper, more complex process. Central banks also control something even more fundamental: how much money exists in the first place, shaping stability, risk, confidence, and behavior. In the old days, the amount of money was limited by how much gold a country had, physically stored within vaults and reserves. Today, central banks can simply decide to create more money. They do this through a process called quantitative easing. Here's where things get really interesting and far more complicated than expected. When a central bank wants to pump more money into the economy, it doesn't just print physical cash anymore today. Instead, it creates digital money and uses it to buy bonds from banks and other institutions, injecting liquidity directly into financial markets worldwide today. These institutions now have more money to lend out. More money in the system means more spending, more investment, and hopefully more economic activity. Now let's add another layer to understand how everything connects. Central banks don't operate in isolation. They're constantly watching something called inflation, the general rise in prices over time, shaping decisions long before people feel the effects. A little bit of inflation is actually good. It means the economy is growing and people are spending money with confidence, optimism, and future expectations. But too much inflation means money becomes worthless too quickly, eroding savings, wages, and long-term financial trust. Too little inflation or deflation means people stop spending because they expect things to be cheaper tomorrow. Central banks try to keep inflation in what they call a target zone, usually around 2% per year, balancing growth, stability, confidence, and long-term economic expectations. This is like being a DJ at a party. You want to keep the energy just right for everyone involved. Too quiet and people leave, losing interest, momentum, and engagement. Too loud and people can't handle it, becoming overwhelmed, stressed, and disconnected. But here's where the system becomes truly complex. Central banks also act as the lender of last resort. When banks get into serious trouble and can't get money anywhere else, the central bank steps in to lend them money. This prevents bank runs, where everyone tries to withdraw their money at once and the entire banking system collapses. During the 2008 financial crisis, central banks around the world had to use this power extensively. They prevented a complete collapse of the global banking system by lending hundreds of billions of dollars to banks that would have otherwise failed. Let's add one more layer of complexity. Central banks also regulate the banking system itself. They set rules about how much money banks need to keep in reserve, what kinds of investments banks can make, and how much risk they're allowed to take. Think of them as both the referee and the emergency medical team for the entire financial system. Now, here's something most people don't realize. Central banks are usually independent from the government. Politicians can't just call up the central bank and tell them to lower interest rates before an election simply for short-term political advantage purposes. This independence is crucial because it prevents short-term political thinking from damaging long-term economic stability. Different countries have different central banks with slightly different approaches, shaped by history, culture, crises, and economic priorities. The Federal Reserve in the United States, the European Central Bank, the Bank of Japan, and the Bank of England all have the same basic tools, but they use them in different ways based on their specific economic situations. So what does all this mean for regular people? Every major economic decision in your life is influenced by what central banks do, often indirectly, quietly over time. The interest rate on your mortgage, the return on your savings account, the availability of jobs, and even the price of your morning coffee are all connected to central bank decisions. When central banks work well, you barely notice them. The economy grows steadily, prices rise predictably, and banks remain stable under normal conditions. When they make mistakes or face impossible choices, entire countries can experience economic chaos very quickly. The fascinating thing about central banks is that they're simultaneously incredibly powerful and surprisingly fragile. They can move markets with a single statement, but they're also constrained by global economic forces much larger than any single country. In our interconnected world, what one major central bank does affects all the others in complex, often unexpected ways. When the Federal Reserve raises rates, money flows out of developing countries and back to the United States, reshaping global capital flows significantly. When the European Central Bank prints money, it affects exchange rates around the world, shifting currency values and trade balances. Central banks represent one of humanity's most sophisticated attempts to manage something fundamentally chaotic, human economic behavior. They use mathematics, psychology, and sometimes pure intuition. And yet, for all their power and complexity, central banks are run by people making educated guesses about an enormously complicated system. They have more data and better models than ever before, but they're still trying to predict and control something as unpredictable as human behavior on a massive scale. The next time you hear about interest rate changes or economic stimulus, remember that behind these decisions is a small group of people trying to steer the massive ship that is the global economy. They're not perfect, but they might be the only thing standing between economic stability and complete financial chaos. So central banks are simultaneously the most powerful and most invisible institutions in modern society. They touch every aspect of economic life, yet most people couldn't explain what they do in their daily financial decisions. They prevent disasters we never hear about and sometimes cause problems they're trying to solve through unintended consequences over time. There's another crucial aspect to consider before the full picture emerges. The effects of central bank decisions don't happen immediately. When a central bank changes interest rates today, the full impact might not be felt for 6 months to 2 years. It's like steering a massive ship. You have to anticipate where you want to be long before you can see the results of your actions. This time lag creates a constant challenge. Central bankers have to make decisions based on economic data that tells them where the economy was, not where it's going. They use sophisticated models and forecasts, but they're essentially making educated guesses about an uncertain future. Here's something fascinating. Central banks don't just manage money, they manage expectations that shape future behavior, decisions, and market psychology. If people believe inflation will rise, they might demand higher wages or charge higher prices. actually causing the inflation they feared. Central banks spend enormous effort trying to shape what people expect will happen, because expectations can become self-fulfilling prophecies. The communication aspect is equally important. What central bank officials say can move markets instantly. A single word in a speech can cause currencies to rise or fall instantly across global markets. This is why central bank communications have become incredibly careful and precise in wording, tone, timing, and intent. Every statement is analyzed word by thousands of traders and economists around the world, searching for hidden signals and implications. Looking at the bigger picture, central banks represent a fascinating experiment in economic management, shaping modern societies, markets, and long-term stability. For most of human history, economies just did whatever they did naturally: booms and busts, inflation and deflation, growth and recession. Central banks are humanity's attempt to smooth out these natural cycles and create more stability. The question remains, can small groups of experts really manage something as complex as a national economy? The track record is mixed, with successes, failures, trade-offs, and unintended consequences. Central banks have prevented many potential disasters, but they've also sometimes made situations worse through well-intentioned mistakes. What's certain is that in our interconnected, complex modern economy, the alternative to central banking, just letting markets do whatever they want, would likely create even more instability. Central banks may not be perfect, but they're probably necessary for maintaining stability in complex modern economies. In the end, central banks are humanity's attempt to bring order to the beautiful chaos of economic life we collectively created. They represent our best effort to use knowledge, technology, and careful thinking to manage something fundamentally unpredictable: how billions of people create, spend, save, and trade value with each other. Whether they succeed or fail affects all of us, every day, in ways we're only beginning to understand right now.